Hello everybody, it's Maxwell here, very early in the morning, Saturday, September 27th, 2014. It's actually 6:45 a.m. here on the East Coast. Today I got a lot of requests for an instructional tutorial and on like different things like chart patterns, which I'm going to discuss in this video, that I use that I find are very highly important, and why people need to understand these patterns, because it happens every day, like repeats itself every time. So what we're looking right now is the E mini S&P 500 index futures December 14th contract. Just a quick little layout here. We're just looking at on top with what people classify as just a plain stock chart. That's a price chart. That's a candlestick price chart. Let's get it right. Down below here we have the volume. As you can see, the little bars on the volume, the bottom are the volume. So I've highlighted some activity in the past week, and let's start with Wednesday. Okay, to the end of this week. Okay, so Wednesday we saw, and I highlighted that oval for a reason. That oval is there for a specific reason. Okay, because that oval is what really made the market happen. And it was a very important buying opportunity. So what I'm going to show you is what I like to call a leg. So this right here is this is the overnight trading pattern. Like from here, this is the new session. It's about here, this is like 4 or 5 a.m. I bought in right here. Right where that little tiny little dot is, okay? That buy point. Because I knew that with the bottom reversal right here forming, that there would be a spike somewhere. I did not know exactly where it would be, but there would be a spike. So I bought right around this area right here. So it went up a little bit, and then it started going down. I knew it was not going to retrace below this point this bottom right here, this pivot point right here, because it never does. I deleted the chart tool, but I was using what's called a Fibonacci percentage retracement tool, which basically predicts where the market is going to retrace before it bounces back into the uptrend or downtrend, whatever trend you're prospecting on. So where was I? Right here. So I knew it wasn't going to hit any lower than the previous low that it had hit. So I wasn't worried about that. So then there was a peak rise, and I should have sold off here, but I didn't, because I knew for a fact that it was going to decline again on a 66% retracement, breaking that low, but then this would be a major buying point. Because why? Because there was a high amount of volume, the highest volume you saw that morning, at that point, in that very point in time. For those who don't know, high volume always translates into buying. So if there's a high volume on a downtrend, it means the market's going to shoot up after that volume decreases. So that's a key indication. That's a fact that happens every single time. And that's one of the key technical indicators that a lot of people don't understand. I'll get to that later in another video. But first, let's focus on what actually happened and how we made millions of dollars doing this. So we bought in low right here. Now at this reversal point, this reversal or pivot point, as some people like to call it, was big because a lot of people buying the market. There's more supply than demand, so this is going to cause a huge spike in price. What do you know? Happens every time. Stock market opens. Boom, look at this, climb. That was about $700,000 right there of profits. All because we know the key technical indicators that enable us to buy, when to sell. This is not beating the market, but it is giving you key indications on whether to buy or not. Thought I'd make that clear. So we're about here, and I didn't really want to sell off because I was like, well, it's going to retrace again because it always does, and it's going to retrace again and it's going to shoot into another uptrend. What do you know? Retrace is about 30% or so, which is a key Fibonacci number, and boom, look at this. I sold off right here. Let's just add like a little price level. Right there. That line is where I sold. And we made about $7 million. Okay? That in itself, if you don't think I'm smart because of what I just showed you, I encourage you to come learn with me because it's a strategy. It works every time. It works every single time because these are facts. These are market facts. It's psychological. People think this happens, and sometimes it does, sometimes it doesn't. But anyway, that was Wednesday. I didn't really do much trading overnight, Wednesday night, Thursday morning. Okay, so now let's look into Thursday. Thursday was a shocking day for this contract because let's actually zoom in for Thursday. I think it'd be great if we could just zoom in for Thursday. Boom, right there. Okay, Thursday was horrible for the S&P 500 because look at this. Major downturn, okay? If you're not seeing this, this right here relates. This is not a crash. This is called a bear market because people. It's a selling climax. It's a sell-off. So for those who don't know, I did not really see the half of this coming. I think I sold off right about the 1972 level, so that would be about like right here. So if you look at that, I sold off right here. That's a sustainable amount of profit lost. However, I made it in time because look at this. Choppy, very volatile. And I just left it for the day because usually after major sell-offs, there is a lot of volatility and options are very, very overpriced. This is one of my good videos that I will be explaining, this is the only video that I will be explaining, volatility, especially in charting. But yeah, the main actually purpose of this video is for market recap, and technical analysis, kind of like dual view. But yeah, that's it. So that's this week on the S&P 500 minis.